conversation forward. Dinshaw, good morning. Thank you for joining us. Markets are up or down. I always tell my friends that you can be assured that Dinshaw will always come on the show with a big, bubbly smile.
Right. Thank you, Nikhil. Thank you for having me on your show as usual. And a very good morning to you and your team and your viewers as well. Thank you.
10% down, markets 15% down for average mid small cap stock. Your portfolio must have also taken a hit, but no sweat on your brow.
Yes, so Nikhil, we were lucky. I mean, we've always, as a house, we've always tried to do one thing which our hedge fund has taught us always. We've been running a hedge fund for the last 16 years. And what that has taught us is to conserve on the downside. So when you're looking at market volatility, what we try to do is reduce the beta of our portfolio by getting into large caps, which conserve you on the downside. And once the turn happens, you tend to get into other high beta stocks like mid caps, small caps. That's what we've been doing. And fortunately, this time around, it's worked out perfectly for us. We've been cautious for a while, as in probably a month or two. We've been cautious on the mid cap, small cap space. I remember coming on a channel and saying the same a couple of interviews back. And that's what we've been practicing. So we've been insulated to that extent.
Why are you cautious? Is it about your view on the economy where markets are overexcited about FY23 prospect and which may not translate into reality? Or is it about pure valuations where economy will do well but everything is in the price? There's a difference there, Dinshaw, because one is that you get disappointed because of the economy and earnings, and second side you would say, look, the economy is doing well but markets have run up. I think,
hang on, I came back. There was some connectivity issue.
So Dinshaw, when you say you're cautious, there are two reasons. One, you would say that, look, markets are overexcited and over-optimistic, and we are in for a marked disappointment. That's one. Second, you said, look, economy is doing well, things are looking up. It is just that the markets are pricing in everything. So everything will come out as anticipated by brokerages, by your analyst, by your internal assessment, but my prices may not go higher because everything is priced in.
Was ports will not be able to sustain this.
I can see you, Dinshaw, but I cannot hear you. I'll tell you what, there is a bit of a problem. We'll fix it. Never mind. Dinshaw, just bear with us. We'll fix the problem. I'm going to just turn my attention to the screen and see what I can identify. I think there's a network issue because my screen is also taking some time to load up today. So there's Mahindra & Mahindra, which is looking strong, but there is Tata Motors, which is coming down. There is no uptick on the bank nifty, but ICICI Bank is holding strong. I think we are in for are we in for a day of profit booking? It may well happen. But one trend I think is very evident is that with each passing day, markets' ability to shrug off the medical news and look through it, I think is becoming incredible. We'll put that graphic out, which okay, I think Dinshaw is back. Okay, Dinshaw, you started responding to my questions, so I'm assuming that I don't need to ask again.
Has given me some trouble since morning, but let me tell you that our caution was basically because we realized that this rising tide is lifting all boats, and some of these boats don't deserve to rise. I mean, some of these, as I told you earlier also. So that's what the caution was. And the fact that some of the small cap as a group or a mid cap as a group, they had far outperformed the large caps and their valuations were looking totally stretched. And that's what made us cautious on this. In terms of the valuation, let's understand one thing, that even the global markets as a group is one standard deviation away from their 10-year averages. We are at 1.5 standard deviation away, I believe, from our averages, which is not too bad at all, because some of the global markets don't deserve to be where they are. At least we have a potential to grow. We have a good economic growth in front of us. We have strong valuation. Strong fundamentals as such. And as a house, we've been always saying that the balance sheet of India Inc. has improved, and as a result, for stronger balance sheet, you tend to pay higher valuations. And that's what is happening in our case. So that was the main reason for our caution. And I think the correction which came by was a very healthy one. As you would know, that in a bull market, the corrections are already savage, and that's what happened. And I think that has drawn in a fair bit of new players. You also mentioned about FII selling, which was pulling down the markets as such. But that, I believe, is because India has outperformed so handsomely its regional markets. So I think there's about time, it's end of the year. So some of these FIIs are justified also to dip into their profits a bit and move some money out. So that's what our feeling was. And that's why I think we're back in again in that game.
So Dinshaw, are we in that phase where you would say, look, I want to keep 6 longs, but also 4 shorts? Are we in that phase of the market? If yes, tell us where you think markets have run up and they could come down. We talk about, in a bull market, you always say, kya lene ka, what to buy. But if your view is that it's a rising tide phenomenon which has re-rated everything, how about discussing things where you think prices or underlying stock prices, they need to come down? And for a hedge fund who's got no emotions but only a view on valuations, where are you going short?
Well, I'll make a lot of enemies if I reveal the names that I'm short on. So I will not be doing that. But meanwhile, so we are always short. Okay, we are always, our net is in the hedge fund, our net is always at 60 to 80, depending on our view of the market. Today it is at 75, 76 odd. So that's the good part, that we're still bullish on the market. I didn't say that the rising tide lifted. I said lifted all boats, but I think that the tide is now not the one which is to look forward to. It has to be stock picks which will matter, and that's where we come in. I mean, with the group as a 16, 17 years of experience, I think we're well placed to manage that to a greater extent. And individually, you all have 20 years plus of experience within the group, so that way we're very well placed. On the frothy front, I think the two-wheeler space looks fairly frothy today, and the fact that even the festive season couldn't lift up sales. EVs is proving a big competition in that space. Ola doing those kind of bookings, which was mind-blowing for everybody. I mean, which was an eye-opener for everybody as such, I suppose. So that way, disruption has kicked in. Raw material prices are creating havoc in that space. So I think that's one space where one has to be careful. Even in the consumption space, there are certain durable stocks which are way above their historic valuations, and the growth rate do not justify. They've not been able to pass on their raw material hikes to a greater extent. So these are the spaces that one has to be careful about and probably be a bit cautious there. So.
Good morning, Dinshaw. So, when we look at the recovery, we also look at the IT stocks and how they perform. The reason I'm asking you this is because you and Helios have always said you're overweight on IT. But the valuation run-up we saw, like even if you look at a TCS, the PE averaging about 30, higher than the historical average of 20, you can look at Infi and all of those other counters, but they're also in the midst of a multi-year growth story. How are you approaching a sector which you've always traditionally said you're overweight, but we've seen the kind of run-up that we have?
So Nandar, I mean, I remember coming on your channel and pointing out Nikun's age when I told him about the P's of IT companies. I think we're still there. I mean, I remember saying that not so long back, the P's were at 30 times when the growth rates were good. And I think this is, if you go on to these calls of these managements of IT companies, you will hear them say that we've been in this business for the last 30 years and we've never seen these kind of growth rates, or we've never seen this kind of order book in our lives and the kind of demand that we see. So it's obvious that they're in a once in a lifetime kind of a phase, and obviously the valuations will be fairly expensive here, and they will remain so. Our feel is that probably 30 is what the peak valuations were earlier, but I don't believe that they'll stop here. Our still feeling as a house is that they may just go over that hurdle if the growth rates kick in to say the mid 20s as everybody is looking at in the next couple of years as such. And this is a sustained growth rate we're talking about. I mean, the dynamics of that industry are looking phenomenal. And I mean, as I tell all my investors that, I've been covering this sector from 2000 onwards, and the fact that to get one single bullish statement from them used to be a task for me. And nowadays I just have to sit back and listen to their bullish statement. So it's obvious that they're in a very a very bull phase today, and they're looking good for the future too. So we'll continue to remain overweight in that sector, and I think it's got another 3-4 years to run as such. So stay there.
Dinshaw, you were talking about froth and you talked about it with relation to the EV space. Now, what about the froth in the primary markets, and how is that, according to you, going to pan out? I did hear Sameer Arora, for example, recently say won't touch an IPO till 31st March.
Yeah, so I think last time around also you started the interview with this. So again, I think you saved this question for us only out here. But the fact is that, the IPOs in the pipeline, I think they learned a lesson when Zomato listed. So they doubled their valuation expectations. And they've doubled it again once Nykaa listed. So I think now today what you're getting to see is probably at 4x the valuations of what they were expecting prior to the Zomato IPO as such. So it's obvious that you're paying a lot for these companies. I mean, in our case, at least, we cannot justify the kind of valuations that these stocks are going to come at. So earlier we thought that probably you'll get a huge pop at the time of IPO. I think now the pop will be much more reasonable pop after the few. And in fact, I think Paytm was an eye-opener that the fact was that people lost a lot of money there as such, and despite being so highly oversubscribed as such. So, just being scraping through as such, so people lost a lot of money there. But still, I think IPOs, we are going to be cautious on that. Probably it's selective, but not touching many.
Okay, fair point. What about regional healthcare companies, diagnostic companies, Dinshaw? Because, the second quarter has told us that even the non-COVID business is doing extremely well for them. But could they become large and national players in the years to come? And is the time to bet on them right now?
Okay, so Aisha, the diagnostic companies, our view is very clear that I think there's a big technological disruption about to happen out there. And that's why we'll be more than cautious in that space again. In fact, that's what all these invasive kind of tests that they do, there may be just a time in the near future when you just have a handheld device which will test you for everything that you need to do. I mean, 50% of the tests will go defunct if that happens. So that's why we're very cautious in that space. They were lucky that, ironically though, that COVID continued in the second phase, and now with Omicron again, there's another wave happening here. So I don't think we'll be very keen on getting into the diagnostic space in a hurry unless the valuations look exciting enough. So otherwise, no.
Omicron, Dinshaw, you were right with it the first time. That's how you're supposed to pronounce it.
Confused only.
Yeah, trust me, it took a lot of training, but Omicron it is. Okay, you talked about banks, and that was an interesting take, but what happens to BNPL? What happens to fintech revenue growth? I mean, can that really eat into the larger pie of banks? And more importantly, I think the critical question is whether or not they can generate profitability in the longer run or not.
So internally, we have a joke going that buy now, pay later is going to be very soon converted to buy now, pay later as such. So that's the internal joke here. But the fact is that how is it different from any other offering from a bank or an NBFC per se? So I don't think, and frankly, if you talk to these fintech guys, they themselves tell you that if they need to grow, they'll have to convert to an NBFC and probably a payments bank at a later date. So I don't think there's a competition here. They need to tie up with banks, which is an additional growth area. That's why you saw some of these guys tying up with a HDFC Bank or ICICI Bank and so on and so forth. So that's the whole way forward for them. So it's I think a growth avenue for banks rather than a competition for banks coming from these guys per se. I don't think the banks corrected because of this reason. I think it was a global phenomenon which was happening across. Started with US banks when the yield curves out there started flattening out. and they have a reason to correct, but we didn't have a reason. I think it was mainly the global trend falling into India per se. If you look at the profits pre-provisioning, operating profits pre-provisioning for last year, a bulk of them were taken away by provisioning by banks. But this time around and this year, I don't think that's going to happen. So banks are going to look very healthy going forward, and that's what I think is. I think Nikunj asked which kya lena hai. I think this is the sector you need to be in if you're looking at a rally going forward as such.
Fun, and this is a real tough one. Do you think Paytm deserves to be a 4-digit stock or a 3-digit stock?
Well, I don't know about the digits part, but I think it's still. I mean, that's what our house view is. It looks fairly stretched at this point in time, so won't comment whether it's a 3-digit or a 4-digit stock. So leave it there. Just that it's fairly expensive even today.
Dinshaw, why Nykaa and Zomato have not fallen? I'm just trying to understand that our market's sending us a message. I'm keeping there is a price decline in Paytm. Star Health IPO, even though it was backed by the folk hero of Indian stock markets, the man whom stock market participants they almost worship, Rakesh Jhunjhunwala, it did not see a euphoric response. So markets are telling you that look, we know how to separate wheat from the chaff. Whether it is a great homegrown brand like Paytm or a great company backed by Rakesh Jhunjhunwala. So it's not that everything in the IPO market is now getting crazy.
Right, you're right, Nikunj. On Zomato specifically, I mean, we believe that it's mainly the scarcity value which is holding up the price, because and frankly, I mean, if you go and see what's happening to a Meituan in China or a Grab in Singapore, all these guys are doing phenomenally well. So it's obvious that the only listed option you have today is probably a Zomato in this space. And that's why it'll command a scarcity value as long as it is the sole player in the market, which I think it will be for a while, because I don't think Swiggy is looking at an IPO in a near future as such. So I think it'll sustain its valuations per se, and maybe go up a bit or no. I don't know. We're not too keen on this sector anyways, because we again believe that the valuations are fairly stretched. You cannot justify an EV to sales of 26, 27 times forward earnings as such. So there's no way we'll be getting into this space per se. But that's our feel on Zomato in particular.
Well, Dinshaw, keep smiling and have a wonderful year ahead. Thank you for joining us, and certainly hope to see much more of you going forward. Markets, meanwhile,